We've been hearing the exact same things. LPs have taken a call. Early stage investing in India seems to be coming of age. I think more importantly, LPs also recognize it's not just early stage tech, but it's also early stage non-tech. If you step back, I think there are enough and more areas in India that, like technology, need to get developed. A good example would have been logistics or warehousing or agriculture for that matter, where early stage investments need to flow in to develop these areas. One of the exits we've had recently clearly is proof of the fact that serious returns are there to be made in that space.
True.
And it's not just Mayfield, there are other firms who've also made serious amounts of money in early stage non-technology sectors such as education. So I think LPs are very correct in their assessment in saying, wait a minute, early stage seems to make sense. India seems to be at a place today where the US was in the 60s and the 70s, where the core infrastructure is getting built up. But for this core infrastructure to get built up, you need ancillaries such as logistics, warehousing, you need the general population, you need education going in there, stuff like that.
Saying is absolutely correct. I think the opportunity as we see it is in the early stage, which is where we invest, but not only in technology. Because there's been a deficit in the build-out of infrastructure, because the Indian consumer is only now starting to spend, you're seeing a combination of factors that are happening in India today, which is actually great for an early stage investor, such as ourselves. Not just in the technology space, but in the consumer space, in almost every sector.
Sure.
We're finding companies that are capable of discontinuous growth and sectors that are capable of discontinuous growth. And our challenge is to find the right management, to work with them, to make sure that we're giving outsized returns to our investors.
In fact, I would go a step further to say some of these sectors are very under-penetrated or under-researched. We typically go out there, look at, meet up with every company out there in a sector or a sub-sector. What we found is, there's invariably one or two promoters or founders who understand the evolution of the industry or the value chain.
True.
And are eventually investing behind that evolution such that they either integrate forward or backward in the value chain and become a virtual monopoly is the wrong word, but a market leader of that value chain. And that's where they really create alpha for themselves and their investors. I think that is a larger opportunity to see where the ball is going, not going where the ball is.
Okay.
And by the very fact that not many people are investing today at the early stage non-tech side, that makes it very attractive in terms of price as well, eventually which results in good returns.
Good trend is, the biggest point for us is we always invest behind a promoter. And the trend that we're seeing that we're very happy about is that the smart promoters, the smart entrepreneurs are recognizing that venture capital funds like us can actually add value. Beyond just adding money, we can open doors for them, we can help them think through their strategy, we can help them in their growth path, and therefore they're looking to bring people like us on for more than just that money. And then it becomes a win-win partnership. We can help these promoters, help these entrepreneurs build their firms out, as we're doing with a number of our portfolio companies. And there's value creation all around. What we end up doing is we do a lot of top-down work ourselves. We say, what are the sectors where we believe there's going to be discontinuous growth? And then we do a lot of the work ourselves. So Vikram and I will go out and actually go into those sectors, meet every company in that sector, meet every entrepreneur in that sector, and take calls ourselves as to who we think is the right guy, who understands what kind of value we can bring to the table. And I think build relationships over a period of time. So it doesn't end up being a transactional relationship. You've actually understood the promoter, you've been meeting him over a number of meetings over the course of a year, 2 years, so that when he's actually looking to raise money, you already know where he's at. So you're de-risking yourself from that perspective. You've also understood the industry dynamics, you've seen what is happening, and bear in mind that if you're looking at a non-tech sector, it's not an all or nothing game. You're not just building brand and spending large amounts of money and trying to build a franchise very quickly. These companies have assets, these companies have distribution, these companies have revenues, these companies have profits. None of that is going to fall off the table tomorrow. Your growth may slow down, but you are still creating value every step along the way. And that's really what we're looking to create. And by doing that, I think we can create long-term value with these entrepreneurs.
First of all, I think just working with the founder, Rajesh Lihala, was a pleasure throughout. I think he's represented a new breed of entrepreneurs that understand private equity, venture capital, and how to work with investors. So it was a thorough pleasure working with him. What was unique about it was actually the 4C model has been played out globally. So when we did our top-down research, what Nikhil was saying, is we realized this is a model that was proven all over the world, but had not come to India yet. What the company does in a nutshell is it uses railroad and sea to transport liquid cargo using specialized containers all over the country. What he did exceptionally well was focus on execution, focus on people. He brought in the best of breed people into the team, focus on execution. He approximately grew 100 times over a 5-year period. Now that is exceptional growth. Today he is number 2 in Asia and probably number 3 globally in his space. For an Indian company to achieve that status in such a short time span is truly very good. Our experience working with him, raising money, making sure he was well funded was our primary responsibility. He was meeting his targets. He clearly said, look, where you guys add value is make sure we have enough capital on hand at any given time. And that's how the last round happened as well.
I think it's not necessarily a valid comparison, because if you look at Consum, it's a service. You're paying for a service, you're paying for a period of time when you can avail of that service, and if you like, the more successful Consum is, the more quickly it has to find new customers. Unless you come back a second time and get married again. And we have
that happens.
And we have divorcematrimony.com as well. So you have second matrimony. Flipkart, I think the comparison is to big box retail, right? You're trying to create a Walmart where you're saying you can buy everything. So the two are very different animals. The creation needs to be different, the capital requirements are different, the success points are different, the length of investment period is going to be very different. Amazon took almost a decade to break even. I don't know how long Flipkart is going to take. So, I think there are different kinds of investors for different kinds of investments. A Flipkart investment is a very long-term, heavy capital investment type of transaction. Consum is a services business. It's highly capital efficient, as would most services businesses on the internet be once you've achieved a certain critical mass. And so, very different. So, I think there's enormous opportunity for hyper-local services. Indians love to have deals. Indians love to go to restaurants. Indians love to get local deals. And I think the more hyper-local you can get, the more focused you can get on those services, those deals, the more successful you will be. You've seen that work very well in the US. And I think we will see that work in India. I think it's still very early days. I think there is a market for 2 or 3 players in that space who will provide the services and provide what the customer is looking for. And I think that is being built out. And I think our investment is certainly in the contention for that space. I'm sure billion-dollar companies will be built. I think the way we approach this at Mayfield Fund, it's the same discipline that we bring to every one of our investments we look at, and if it fits into our investment criteria, we will make the investment, and if it doesn't fit into our criteria, we will pass on the investment.
I believe we are paying great prices. Proof of the pudding is in eating it. We've seen some seriously high markups, and we've seen some good exits. Fact of life is that only happens if you've paid right prices while getting it. If you pay high prices while getting in, you're not going to get good markups or good exits eventually. So I think we are in a space where we're not seeing much competition, we're paying good prices. So early stage is not, the point I'm trying to make is early stage doesn't necessarily imply inflated prices. It really depends on the spaces you pick for yourself and decide to go and invest in. If you pick a space where the whole world is hunting, you are going to end up paying high prices.
You know, Shrija, we've seen more than one cycle. Vikram's been in the industry for 10 years. I've been in the industry for capital markets, private equity, 20 years. And, you know, the one thing I would say is transparency, consistency, and above all, results. And if you can show that, I think LPs would.
So the one consistent LP strategy which I have seen over 10 years, and I'm sure Nikhil will say he's seen over 20 years, is LPs back people who make money.
Yeah.
So there's a certain consistency in that as well. If you have a track record, there's consistency. If you're transparent, you build credibility in the market, you will raise money.
Do what you say what you do, and do it well.
Absolutely.
We're very clear about our strategy. What we do today is what we're going to do tomorrow. Fund
Early
size,
stage.
deal size, we want to stay where we are.